wait, is it SPIVA or SPIVA?
I say SPIVA.
I was about to say potato, and then it occurred to me, what unhinged maniac out there says potatoes?
Wait, tomatoes. You don't say tomatoes? Or is it just potatoes? Potatoes?
You say tomatoes? This podcast is over. Hey, Matt Robison and Mike Morton. It's Financial Life Planning. Also, our enunciation seminar. If we've just offended anyone in the audience who is really big into saying tomatoes.
Or potatoes.
I'm sorry. Well, I'm not going to apologize to the potato
those
crowd.
guys.
How long has it been since you've heard someone say potato? Unless it's like Louis Armstrong.
Let's see. How old
singing.
am I?
Yes, exactly. Like that song no longer makes any sense.
It doesn't make sense.
I guess it's kind of like the way in the 1930s in movies, everyone was like, "Let me tell you something, dame." No one talks like that anymore. All right, but you want to talk about SPIVA reports, and we're back to a theme that really runs through this show, which is awesome.
Yeah, losing your low cost index fund, that would be bad, but using them is great. So low cost index funds versus what's the opposite is actively managed funds. So index funds are sort of passive; they just follow whatever the predefined index is. Okay, versus actively managed, I'm trying to pick stuff, in my fund, mutual fund or ETF. So index versus active funds, we, tout low cost index funds. And the reason why I don't know if we've gotten into the reasons or had a lot of recap on it, but SPIVA puts out a report about index funds versus actively managed funds. And the evidence is overwhelming that you should be in index funds. And so that's why, I thought it was worth bringing up.
All right. I'm really happy to get into this topic. And the fact that you just said kind of passive versus active reminds me that at the very end, people are going to want to hold on because we've got a little thing to say in our one thing segment about the benefits of being inactive. So let's hang on for that. But all right, back me up for a second. Just remind us, what do we mean? I know it's real basic, but I lose sight of things. Yeah. What do we mean by index funds to start with?
Right. So index funds means it's based on an index. All right. And when these were first started, in the 70s, maybe before, there weren't that many indices. So the S&P 500, that's an index. Right. It's the top 500, basically the biggest 500 companies in the US. There's the Dow Jones. The Dow Jones, that's 30 companies. Okay, that's an index. You could say all the US based companies or everything that's listed on the stock exchanges here in the US, about 3,500 companies. So that's a list, right? So that can be an index, total US stock market, total global market. But then there's also like healthcare, US healthcare. You could say like, oh, these 200 companies are in the healthcare sector. We're going to have an index of healthcare. It's those, and it's easy to define who's going to be in it. Anybody that's in, healthcare, right? So now there's lots of different indices, but what's important about them is that no one's sitting around picking individual companies. They just have to make sure they fit into the index.
And the benefit of an index, I imagine, is like the benefit of anything else where you're kind of averaging is you're taking out a lot of the variation because you've got an average, right?
Well, we don't know if there's a benefit or not. That's what we're going to talk about, the SPIVA report, right? So is it better?
I mean, in terms of like why they did this in the first place, like, as opposed to picking out like, I'm going to invest in this stock, it's broader.
Yeah, but is that better or not? I mean, it's a really good question. Like when you're sitting around, you would think, well, there were smart people picking company. Why would you not pick companies? Like you can look at the landscape like, oh, these guys are definitely going to do better than these guys. Like I'm going to invest in those. That seems better than just buying all of them. Why would you buy all the companies? Some of them are going to go out of business. That doesn't seem very smart. So
I see.
So I don't think there's any preconceived notion like which is better, but I'm just saying this is what indexes are. You just define a universe, small or large, of companies, and it's easy to know kind of who fits into that.
Got it. So there are different kinds of indexes. Yep. There's different kinds of them, and this really took off though because this was pioneered, like you said, in the 70s. And then you really saw a shift toward a lot more interest in investing in index funds over the course of the decades.
Yeah, and I think that's because people found out like, oh, wait, this might be a better way of doing it. One thing, it definitely leads to lower cost. And that's pretty self-explanatory, right? Like if I know I'm investing in the S&P 500, I don't need a whole team of people. I need a few people. Like, okay, what are the 500? Make sure they're all in there and kind of watch it, right? So, if you're not actively investing, you don't spend a lot of time and effort trying to figure out which companies are going to be in my fund. You just buy the index. So that's why they're usually correlated with low cost. We say low cost index funds because they don't cost a lot to manage. So they pass that savings on to the consumer. So they're, don't cost that much to buy.
I see what you mean about it being non-obvious that this would be better than actively picking a series of stocks. It reminds me of a Bob Newhart routine where he imagined a transatlantic phone call between the original settlers, European settlers in North America who were like, okay, we have this leaf. What we're going to do is we're going to dry it out. We're going to send it to you and you're going to wrap it up in a piece of paper and you're going to light it on fire and you're going to breathe the smoke in. And the reaction was like, wait, what?
Wait, what?
Why are we interested in this? Like tobacco is the kind of thing it's not obvious why anyone would be interested in this. Oh. So when when index funds came on the scene, you're saying it was not obvious that this was better.
No, in fact, Jack Bogle is one of the pioneers. The founder of Vanguard was one of the pioneers. And when he came out, the first 5 years, 10 years of sort of his new career, having these index funds and kind of touting them like, oh, people should invest in these. He was just made fun of, So it was completely non-obvious that it was going to end up being kind of a better way, or what we believe is a better way, of investing.
Interesting. And what was he saying at the time? Like, what was the idea of why this was better?
I don't know. Yeah, I mean, I haven't looked into kind of the history, and what was the spiel and what was his, research and theories and all of that. I assume, like you said, Matt,
we just know it's low cost.
Yeah, it's low cost, and the diversification piece, is probably big. And I'm sure he had a ton of research, that was like why it was better. But in terms of going out to the marketplace, going out to investors, and saying, hey, you should just buy the entire market. They're like, but I got a smart guy and he picks the right companies. Why would I buy all of them? It kind of makes sense.
Well, I think what's confusing for consumers is that you have three things and two of them sound very, very similar to each other, right? The first thing you've got is I'm going to pick individual stocks, me. And I'm going to call a stockbroker and I'm going to say, get me 500 shares of Sears. And then you've got a second thing, which is I'm going to call a stockbroker and say, you decide which ones to get, just get me, I've got $30,000. Like, get me in the right set of things. Then you've got a third thing, which is index funds, which is I don't need to call my guy. Or gal. Usually it's a guy. I don't need to call anyone. There's the index fund. I just buy it. And but number two and number three sound awfully similar because number two is essentially mutual funds, right?
Yep. Yeah, exactly. Yeah. So
right. So we're talking about the difference ultimately here between mutual funds where you've got a person, like assembling them and no assembly required. It's already pre-assembled.
Well, let's also not forget, I mean, if we're talking about the historical context, up until about 20 years ago, you and I just couldn't go out and buy stocks at all. Mutual funds, ETFs, or stocks. There was no internet, and there was no way for us to just go and buy these things. You had to have a broker. So you paid that broker. And then what does the broker do? I mean, hopefully they're a fantastic broker. They're looking out for your best interest, but maybe they're also looking out for their bottom line. So maybe they're getting, pitching some stocks to you or some funds that they might get some commissions for, because that's how the whole industry worked, And so you call your broker and they're like, oh yeah, I think this is a really good thing, because of the market cycle and this, I think we should invest in, the healthcare sector, because they get 1% of whatever you invest into that healthcare fund. But let's not forget, that was the only way for consumers to get access to do investing. All right.
I see.
So it's really changed in the last 20 years. And that's been a big tailwind for low cost index funds, right? That everybody can just, good and bad. Now we are responsible to go out and pick and choose what to invest in. So it's harder. But the good news is there's a lot of great options and low cost options and easy things to choose.
All right. So I think we've got the setup of you've got index funds, you've got other kinds of mutual funds that, they're still a human, there's still or I guess there could be a robo advisor, but there's still an entity that's making selections. And sometimes they're buying more of one thing or they're buying a new thing. They're selling other things. There's churn going on in there. Let's cut to the findings. Let's get
hold
to
on
the
a sec.
SPIVA.
Let me just really emphasize what you just said. On the one hand, we have index funds. We defined those. Right. On the other hand, we have people picking and choosing what is in the fund. Mutual fund or ETF, they're picking. So that's actively managed. Okay. Typically they cost more because I have a team of people that's actively picking and choosing. So that's what we're comparing. All right. We're comparing index funds to actively managed funds. Now, SPIVA, and I highly recommend you go to SPIVA. I think it's SPIVA.com, spglobal.com, but just look up SPIVA. SPIVA. All right. Pretty cool website. When you first get the Google result and click on it, it's going to show you a kind of nice map and easily explained. I like the website. So just go there and check it out. What they do is they compare index funds and actively managed funds. All right. So they compare these a couple of points. How do they do the research? It's net of fees. So the fees, they're taking into consideration the fees. Okay. So if an actively managed fund costs 1%, they take that into consideration. Hey, the fund made 7%, but you, the investor, got 6%.
Right. This is all from our standpoint. How much money did you put in? How much money did you get back
exactly.
at the end of the day?
Exactly. Yeah. So that's included in the research, okay? That the actively managed funds tend to cost more. So they have to do better, just in order to keep up. All right. There's also survivorship basis. You might read about this, a big deal. A lot of funds go out of business. Like a lot of funds are launched and they're great, and then they don't do so well and the investors start leaving. So rather than, Fidelity, Schwab, Vanguard, or whoever, BlackRock having sort of, this fund isn't doing so well, it's not on our books, they roll it into something else and just get rid of it. So now it's not really showing up, okay? So that's called survivorship bias, but SPIVA takes that in consideration because if you just look at, hey, these are the funds that are around, let me back test, see how well they did the last 5 years, they probably look pretty decent, but they got rid of the ones that weren't doing very well. So SPIVA has make sure to include those ones.
Got it. So let's give people the bottom line. What's the answer? What did they find?
So they slice and dice the markets all ways, but here's a stat for you. 87% of US large cap funds underperformed the S&P 500 over the last 10 years.
87%. So if you're in a US large cap fund, 87% of them are going to do worse than if you had just bought the S&P 500 index fund.
In the last, over a 10-year period. So
over a 10-year
So
period.
10 years ago, you had a choice. 10 years ago. Hey, should I buy the S&P 500 or should I buy one of these actively managed funds? You had a 1 in 10 chance. 10% of those funds, the actively managed, outperformed. Almost 90% underperformed. You had a 10% chance of picking an active fund that would outperform the S&P 500.
That is not good for the active. Now let's talk about why. Why does this particular, but I think you're saying in general, why do these index funds do better?
Yeah. 2 major reasons, in my opinion. There's a bunch of reasons you can read in the research as well. One is the impact of fees. So we've talked about that. The actively managed funds maybe cost on average 1% a year. Low cost index funds cost almost nothing. So they have to beat the S&P 500 by a whole percentage point every year. I mean, every month, every year by a whole percentage point, which doesn't sound like a lot, but that's a big deal. So I think that's one of the major reasons is the fees just really add up over time.
The other thing is And this is going way back to, my econ 101 days. People are way worse at predicting what's going to do well than they think they are, even experts. It's amazing how we're just not good. And the market, I guess, bakes in a lot of expectations, predictions, the factors that people use to price and predict the future. And so it turns out that we sort of psych ourselves out. It's like the advice you give about trying to time the market, which is don't try to, because most of the time you're going to get it wrong.
Yeah, that's exactly right. I mean, that's what we say about efficient markets. We use that word efficient markets. What does that mean? It means there's hundreds of thousands of people taking both sides of every trade with all the available information. They've researched the company. They know like the global outlook. They know what their company is doing. They've talked to the managers. I mean, there's thousands of people just doing that on every single company. And then some of them buy and some of them sell. So that's what the efficient market means, that the price is set correctly. Obviously, it's going to move up or down based on what happens next, which nobody knows, but it's priced correctly for today, given all the available information. So 2 points out of that. One, what you just said. That's why index funds, look, it's already priced appropriately. It might go up or down, but there's no like easy way to figure out a better choice for today's price. The other point that we often make is, do you want to be picking either individual funds or actively managed funds on your own? Do you think you have better time and expertise than the thousands and thousands of people that work full time in this industry? Probably not.
Probably not. Probably not. And then you add in things like, the high volume traders who have the super high bandwidth connections right across the river in New Jersey. So they have these femtosecond advantages, and they're getting all these little increments. If I just send a bunch of gibberish, I apologize, but it's like there are institutions and there are people who pay to get an advantage over you. To be able to make trades faster than you ever could, than anyone else in the market can. Yeah. And they're soaking up a lot of that value. And the other thing that really comes home when you and I have talked about this before, to me anyway, is this idea that, look, some things are going to go up, some things are going to go down. And to believe, it's what you said a second ago, basically, it's to believe that an actively managed fund is going to do better than an index fund. I mean, you're betting that you're going to be right, or the person who's picking this on your behalf is going to be right, not just more of the time than anyone else, right? But also enough more to make up for their fees. Right. So that, your just broad, diversified index fund isn't going to do better. That's really, really hard to do. And if someone is able to do that consistently, year after year after year, they probably don't need to be managing an index fund or a mutual fund. They probably should just go out on their own.
Yeah. Actually, no, it's a good question. Would they go out on their own? I still think there's more money.
Where can you make the most money?
You can make, I don't know. Yeah, you make more money.
I do a hedge fund personally.
Right. Yeah. Hedge fund or index fund, because you can get hundreds of millions, $1 billion, and you can, your fee is 0.5%. So that's a pretty good way of making monmoney.
That's true too.
So you're exactly right. The other piece is the persistence. So I said the fees, is one piece. I want to mention another piece. Why else index funds? And this is something we should talk about in a future episode. About 4% of the stock market makes the entire return of the stock market. 4% of the companies. 4% of the companies drive the entire return of the stock market over the safe investing rate, which is like treasury bonds. So currently you can earn 4 or 5% just by, buying a US government bond. All the rest of the stock market return, say it returns 10% or 12% or whatever, above that is driven by 4% of the companies in that index. That's shocking.
That's helpful because it means that if you want to outperform the average, you've got to luck into picking.
That's right.
Within that 4%.
That's exactly right. Yeah.
Wow.
It's shocking that it's only 4%. But it's a small number of companies drive the outperformance of the stock versus, those safe bonds.
So I used to, in my radio days, I used to do a show with Chris Hill, who is the host of Motley Fool Money, a huge radio investing. People have heard of the Motley Fool. And he knows everything that, well, not everything that you know, but he
probably
he has the same basic approach that you do based on the same basic set of knowledge. Like, buy low-cost index funds. That's the way to go. But he also likes investing in individual stocks. And he'll say, like, I like doing it. It's fun for me. And he puts in the time. He is an expert and he has theories about the market. He doesn't always hit. We talked a lot about the things that he doesn't hit on. But my point is that if you're listening to this and you're like, hey, I like to invest some of my money, and I get what you're saying about index funds, but I want to invest some of my money in individual stocks because I find it rewarding and I do pretty well and I'm happy with it. Knock yourself out, right? Like, whatever floats your boat. But I think for people like me who don't enjoy that, I mean, I get a lot out of this show and out of your guidance because this is not something I enjoy, believe it or not. Like, this is not where I want to be spending my time. I just kind of want the best return possible. For me, low-cost index funds are fantastic because I don't want to muck around. And so if you're someone who wants to muck around with it, fantastic, great, more power to you. But for the rest of us.
Yeah, well, I totally agree. It's great. It's really nice to be reminded you can sit on your butt and do nothing and be rewarded for that, which we'll talk about for our one thing. But
yeah, we'll talk about that in a minute.
Before we do, just a quick comment on that. If you're going to go out and buy individual securities, I have clients that do that. I always say it's like, hey, it's your money. You could do whatever you want with it. But at the same time, recognize, like, be honest with your results and your returns. If you do track it, which I highly recommend you track, then be honest and compare it to a comparable index funds. Hey, what if I had done nothing? What if I just put this in the S&P 500? I bought Apple, it's a big company in the S&P 500. What if I just bought that instead? So be honest with your results. And I would only do it with a small amount of money. More and more, I'm just coming to the belief that it's like, don't mess around. I mean, you could really hit something sideways. And if you're doing 20, 30% of your portfolio, and that goes down 20 or 30%, whereas the rest of the market's going up, that's a big deal. You might be working a couple extra years. So I wouldn't, mess around with those kinds of things.
Let me ask you one more question on this before we get to our one thing. This feels like something we've talked about as a theme. We haven't done this exact episode before, but we've talked about the advantage of index funds over actively managed funds. We've talked about the drawbacks of fees and how they really build up. They just kind of kill your return over time. And it's kind of baffling when there is an alternative that's easy and is better and just costs you less money up front. It's not like you need to even pay more for the privilege of doing index funds. So my question is, why do actively managed mutual funds still persist? Why are they still such a huge thing?
Because people always they buy on emotions. Everyone buys on your emotion, and it's marketing. And so and it's also standing out, right? It's like, oh, I've got a guy. I hear that a lot. Oh, I've got a guy that picks stuff. I mean, people like that. People like having a financial advisor. Like, oh, I've got an advisor. It just makes you feel good and you pay for it, but there's some emotional benefit, potentially. And some people have that, some people don't. That's why there's a world of lots of different products and services. But yeah, I agree with you, Matt. It's tough to figure out why it's still persistent. But I believe a lot of it's just marketing. There's an incentive for these massive companies to keep doing it this way. And so they keep doing it.
It's just hard for me to think about another example out there of something that is obviously worse and yet still kind of, maybe it's inertia, maybe it's maybe it's emotional factors. I'm just struggling to come up with another example from another realm of life where it's like, yeah, this is really worse for almost everybody, and yet so many people still do it.
I don't know if this relates or not, but there's a lot of different products and services people can buy, and you get to pick and choose which that you want. So I often say like cars. There's a lot of ways to get from A to B. You can buy all different kinds of cars. Why spend a ton of money on one car versus another? Well, it's the experience. I like that car. I like the way it makes me feel.
I just don't. Well, I guess this is why people are different, because I don't get anything out of the experience of my guy calling me and saying,
yeah, that's because I've seen your car, Matt. So yeah, I'm agreeing with you.
People should not take any automotive tips from me. Okay. Well, with that, let's go back to a theme that you introduced at the beginning, which is, one of the psychological benefits, maybe, of actively managed funds is, sounds like you're being active. You're doing things, right? Yeah. Like, you're calling your guy and you're like, what's going on? You got any hot tips? And oh yeah, I've got great things. Index funds, it's like, you're not doing much. You're really being passive. And no one likes that. Our whole lives, we're told, don't procrastinate. Don't put things off. Get it done today. You'll feel so much better. There's a great Frog and Toad story about this that was probably read to you when you were a child. I would like to make a case based on today's episode for the magic of strategic waiting. I'm euphemizing, but strategic waiting. Like, aren't there examples? I feel like you've got one. Aren't there examples of times where it's like, actually, if you sit back and you're intentionally passive, you're better off.
So wait, you're just saying sit on your butt and do nothing. That's what you want to promote.
Yes, I'm questioning big active. Like there's big pharma, there's big tech. I'm questioning big active. I'm saying it's not always best to jump in and act. Right. I think a little bit of big couch. Big couch is good.
Big couch. That'd be great.
Am I wrong? Am I crazy?
I totally agree, man. And so, we just had a whole episode on one part of it. And it is hard. And that's maybe, again, why active kind of wins in some ways. It's still around because people want to feel like I'm doing something, and it's really, really hard to just sit around and do nothing, even though it's, you look at the reports, it's better for you. Another one, when you mentioned this to me, that came up was email or communication, but especially work email. I thought of this. It's like emails come in, the more you quickly respond, the more you write emails, the more emails you get, right? So the more quickly you respond, the more you're going to get back. And a lot of them get solved with you doing nothing. So a work email comes in, oh yeah, I need the blah, blah, we got to work on this thing. You're like, all right, let's just let this simmer for 12 hours, 24 hours. Usually someone else jumps in, first of all, and answers the email so you don't have to, or it just goes away. So actively sitting around, can lead to a lot of results there as well.
Right. It provokes more response. It also kind of gives this feeling to all of your colleagues that you are always available at every moment. Also, the things that I wait and think through to say by email are better. Now, I probably spend too much time wordsmithing emails. I shouldn't do that. But still, look, Abraham Lincoln used to do this. He'd write immediate responses by letter. They didn't have email. And then he'd put them in his desk drawer and he'd just look at them the next day. And most of the time, he never sent it.
I didn't know that.
That's a. I'll tell you one other place this comes up. You and I are both married to doctors. There's a reason why you call to get an appointment at the doctor's office and they're like, yeah, we'll see you in 8 weeks. You're like, yeah, but I have a broken toe now. And they're like, 8 weeks. Because that person's job is to triage. And 95% of problems that you're going to the doctor for will probably get a little bit better if you wait a little bit. And some of them go away entirely. And so they're kind of judging. I'm not saying that this feels great. I'm just saying that they're not wrong most of the time to evaluate, do you really have an emergency situation that needs help now? Or are you going to just feel better in a month?
Yeah. Yeah. Unfortunately, it doesn't work so well in the ED.
That's emergency
department. That's, the emergency department. Anybody can just walk in there.
Well, yeah, your wife's job's a little different than mine. Yeah. Fair enough. Okay. So strategic couch.
Big couch. Let's go.
Big couch.
We should do our next episode on the big couch.
The big couch. Oh my God. That sounds like a Humphrey Bogart mystery. All right. For Mike Morton, Matt Robison. We'll see you next time.
Thanks, Matt.
Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. It makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.